Good morning. It's Thursday, the 21st of August, and this is Govindraj Ethiraj broadcasting and streaming weekdays from Mumbai, India's financial capital. We've had a day of respite from the rains, that is at least the high-intensity rains, but it still continues to drizzle and looks cloudy most of the time. Speaking about cloudy, the Ambanis caught in crossfire as US continues to pressure India on oil. So US Treasury Secretary Scott Besant on Tuesday accused India of profiteering from its increased purchases of Russian oil during the war in Ukraine, saying the US viewed it as unacceptable. Speaking to CNBC's Squawk Box on Tuesday, Besant said that Russian oil now makes up 42% of India's total oil purchases, which is a sharp jump from under 1% before the war. And he contrasted that with longtime buyer China, whose purchases went up from 13% to 16%. He said that India was just profiteering, India was reselling, and what he would call Indian arbitrage, buying cheap Russian oil, reselling it as product, and that has sprung up during the war, which is unacceptable. He said that, or rather added that, some of the richest families in India have made as much as $16 billion in excess profits. Now, this follows US trade advisor Peter Navarro's comment that India is a global clearinghouse for Russian crude and that the proceeds flow to India's politically connected energy titans and into Putin's war chest. Now, these statements are concerning for a variety of reasons. First, while the global oil trade might be somewhat murky, given how, for example, sanctioned oil tends to move around the world, oil to chemicals major Reliance Industries is one of the most visible and publicly traded companies in India. Second, exporting diesel or jet fuel from imported crude has been its strategy since the first refinery was set up in Jamnagar on the western coast of India 25 years ago. The reason why the refinery was set up on the coast, unlike refineries owned by public sector giants like Indian Oil Corporation, which are largely inland, was precisely to import crude and export product. Over time, Reliance, which controls roughly 25% of India's refining capacity, has obviously helped cut India's dependence on petroleum product imports like petrol or diesel. Now, India continues to import over 80% of its crude requirements, but the refining and value addition for domestic consumption and exports by all Indian refineries happens on Indian soil. Now, Reliance's profits for all its businesses over the last 3 years, including oil to chemicals, telecom, and retail, roughly adds up to about $25 billion. So the $16 billion figure that Besant mentioned either might be an accurate depiction of Reliance or might refer to the profits of other refining companies and the difference in profits because of the lower crude oil prices. Now, the details do not matter as much because Besant has clearly taken aim at the Ambanis and thus a business person seen as close to the government. In doing so, maybe he is equating them to the Russian oligarchs, typically very rich businessmen close to the Kremlin whose initial riches came from the privatization of state-owned enterprises in Russia in the early to mid-1990s under then-President Boris Yeltsin. Whatever Besant's intent, the specific attack does signal a further deterioration in US-India relations, at least at this point. It is unusual that Besant, who has managed money for over 40 years and has worked with the Soros Fund Management as chief investment officer until about 10 years ago, would highlight profits made by Reliance, a private limited company, and its owners as unacceptable. Now, attempting to squeeze logic from the battery of statements we've seen in recent days might be futile, but it is evident that there is a continuing problem, which is the friction between India's Prime Minister Narendra Modi and US President Donald Trump, the reasons for which may go back to the period just before President Donald Trump got elected, as various foreign affairs experts have pointed out to us. And therefore, I've also suggested that the continuing problem has to be resolved at the top. Now, while we await that, the Ambanis obviously have a new problem to grapple with. As many in business and politics are realizing, you can get many things done in India, but facing the might of the United States and dealing with a problem that's cross-border is a different ballgame altogether. And that brings us to the top stories and themes. The stock markets rise for the fifth day on easing tariff fears. The government initiates laws to ban real money gaming. So what does it mean? And a look at the background. And why telecom companies are raising prices? Hint, the answer is you.
This is a core report with Govindraj Ethiraj.
The markets gain again. It was the fifth day of gains, and this is where it gets interesting. Lower goods and services tax rates, which could come by Diwali, will help consumer product companies for sure, and those stocks will benefit, as will auto stocks if taxes on cars, particularly the entry-level cars, come down, and thus the price consumers pay for them. There is no real benefit beyond this from a market fundamentals point of view, at least right now. But the macro factors are still strong, and the tailwinds provided by low inflation, low interest rates, and an improved Standard & Poor's rating, and if you want to add good monsoons to the mix, will hold the bottom for a few sessions at least. The Nifty 50 managed to reclaim the 25,000 mark after about a month. The index last closed above the 25,000 mark around the 24th of July. The Nifty finally closed on Wednesday with a 70-point gain at 25,050, and the Nifty has now rallied about 563 points in the last 5 straight trading sessions according to Business Standard. The BSE Sensex was up 213 points to 81,858, and the BSE Mid Cap Index and the Small Cap Index were also up at 0.4 and 0.3% each. The rupee was down though on Wednesday as corporate hedging and short-term speculators increased demand, which was met by dollar sales by foreign banks. The rupee closed at 87 rupees 6 paise to the US dollar against its previous close of 86 rupees 95 paise. So it's back above 87 according to Reuters. Meanwhile, Russia expects to continue supplying oil to India despite all the warnings from the United States that we've been hearing. Russian embassy officials in Delhi said on Wednesday, adding that Moscow hopes trilateral talks will soon take place with India and China. So these trilateral talks obviously mean more than what you're just hearing. So let's see how that develops. Now, this also means, obviously, that India is not buckling to threats on buying Russian oil, at least as evidenced from the statements made by US Treasury Secretary Scott Besant. If something has changed after that or something that the Treasury Secretary did not know, I guess we will find out very soon. Just to recap where things are, US President Donald Trump had announced additional tariff of 25% on Indian goods exported to the US from 27th of August, which is exactly a week away, as punishment for buying Russian oil, which constitutes 35% of India's total imports compared to a negligible 0.2% before the Ukraine war. These are figures from Reuters. Either way, the total tariff then would be 25% as it is today, which is higher than the 15% that we were expecting. So it's 25%, potentially 25%, so 50% in all. And there are other tariffs and countervailing duties as well. And here's a message from a sponsor. Want smarter investing at your fingertips? With InvestingPro, get real-time market data, custom alerts, and global financial insights all in one place. Join 46 million users already making sharper decisions. Download InvestingPro today. More details in the link below. Real money gaming takes a hit. The Lok Sabha on Wednesday, that's the lower house of parliament in India, passed the Promotion and Regulation of Online Gaming Bill 2025, which aims to prohibit all forms of online real money games. The bill was passed by a voice vote after brief remarks by the Ministry of Electronics and Information Technology, Ashwini Vaishnaw, amidst protests from opposition members. Following its passage, the House was adjourned for a day. The legislation defines an online money game as any game in which an entry fee or monetary deposit is required, irrespective of whether it's based on skill or chance. And more on that shortly. The bill prohibits any person or company from offering, aiding, or promoting such games and bars advertisements for these platforms. Remember all the cricket matches, and prevents banks and other institutions from processing related payments. The gaming sector pays about 28% goods and services tax imposed in October 23, and the sector has been fighting that. Several unlisted companies who are involved in this space would obviously be affected and quite likely have to shut down as things stand. The government has estimated that about 450 million people lose close to 20,000 crore rupees every year in online real money gaming, according to a government official who spoke to the Economic Times on Wednesday. The government also treats online real money gaming as a major societal problem and has chosen to forego the loss in revenue in preference to people's welfare, according to that official. That official also said that online gaming involving money is a major problem for society, and every parliamentarian has raised concerns about its ill effects. And between revenue and 1/3 of the industry segment and society welfare, the government has chosen society welfare, according to that source again. I reached out to Ananay Jain, partner consulting firm Grant Thornton, Bharat, who's been working with some of these industry bodies in this space. And I began by asking him to give us a backgrounder on the gaming industry before asking him about where it stood today.
It's a landmark legislation that has just been passed in Lok Sabha. So the basic premise of the bill is to actually remove the distinction that currently exists between game of chance and game of skill. And that's what the minister, Mr. Ashwini Vaishnaw, has also mentioned in his speech in Lok Sabha. So what he's mentioned is that there are 3 different segments that India will be viewing now. So there'll be one which is your esports, which has a separate federation in the world, which has your streaming influencers working. And then this next segment is the casual gaming, which has your chess, Sudoku, and the likes. And the third is the real money gaming, which is all the fantasy, poker, Ludo, Rummy, all of these apps combined together. So they've clearly made a distinction between the three segments. They've said that the bill is set to promote, and there'll be investments from the government side to promote the first and the second, which is your esports and your casual gaming. But there's a blanket ban on the third one, which is the RMG. Now, RMG in this sector is the biggest contributor in terms of revenue, jobs, around 30,000 crores revenue, which bear in mind is expected to double or triple by 2028. So we're speaking about a huge industry that's actually being shut down if the bill goes through in the period that it's been drafted. Having said that, there is still a lot of focus on innovation, especially with the PM's vision that was there, which he laid out in waves, wherein he categorically calls out that he doesn't want India to just play games. He wants India to develop games now. So I think there's a clear focus and shift that the government wants to promote the industry, but at the non-RMG side and not at the real money side.
Right. Okay. So again, to just to stick to definitions, and this is useful because you've given the three clear definitions between the esports, the casual gaming, and real money gaming. Now, real money gaming is not really gaming in the sense that I think of an Xbox or a PlayStation and then play something, right? It's really, I mean, it's more looking at an app and trying to take a bet on something and make money or lose money, isn't it?
No, it's not that simple. And the word betting might not be correct here because, so in RMG also, there are two segments to it, right? One is the game of skill, which worldwide, if you look at it, there are multiple reports which suggest that, poker, let's say, for example, is a game of skill, right? It's classified, while there is an element of luck to it, but that's there for all of the cases. I mean, if you look at it, the best example of a game of skill is chess. World would agree that, there is no game like chess, which it involves your mind and everything. But even there, if you ask an expert, there is an element of chance because it depends on if you toss up, there's a toss that happens, whether you select white or black, there is an element of it affecting the outcome. So, I mean, I'm just saying that, while it's not traditional gaming as we were used to in 1990s, but a lot of fantasy gaming and poker and rummy was a game of skill. At least it was classified as game of skill till now.
But I mean, I guess the distinction is when you talk about chess. I mean, I don't want to go too much into the merit of this case, but when you talk about chess, but what we're saying really is there's money riding on it, which is what makes the distinction.
Right. And that's a distinctive point that that's what the bill is talking about now.
Right. And as things stand, will the industry which works on the real money gaming part, will it have to downsize or shut down as things stand today?
It certainly looks like that they will need to pivot. So all of these big players, if you look at it, they have a segment of casual gaming and they have a huge database now. So I mean, they will have to pivot to casual gamings and games which do not involve money as things stand right now.
Yeah. But if it's casual gaming and you said Sudoku, for example, is a casual game, if there's no money riding on it, so where is the revenue then going to come from? Is it advertising and so on? Or
It's going to be advertisement. It's going to be in-play purchases that these games have. So you can buy extra lives. You can buy, let's say, for Sudoku, you might be able to get 2 or 3 squares filled, which makes it easier for you to solve the entire puzzle. It will be dependent on advertisement largely, and then your small element will be the in-play app purchases.
and you feel that these in-play app purchases will not be circumvention of what the government is intended to do because it's really trying to stop people from putting money into apps like these, isn't it?
No, so I think the focus of government is to stop wagering as of now. So if you're completing a round of Sudoku and you winning an amount, a monetary amount, then it will be stopped. But if you're actually just completing a level and moving on to next level, then I don't think the government has problem with in-app purchases because what they're citing right now is that there's been a lot of suicides and there is some debt trap. So that's where wagering aspect comes into the picture.
Right. Okay, understood. So let's talk about esports for a second. I mean, we see a lot of esports competitions happening around the country, and it's a sort of definitely a more accepted, legitimate, and desired version of digital gaming. So what's the kind of opportunity that you see there, including for maybe some of your clients to switch to or pivot to?
Esports is going to gain massive boost from this. So there's going to be innovation in there's going to be innovation in terms of development of games. There's going to be a huge content creation, or these influencers that create content that's going to get a lot of recognition now. Government's going to focus on setting up advanced technologies like AR, VR, metaverse. All of that will be the focus now. So there's going to be a lot of innovation and development in terms of both games, and the number of players will increase massively, and federations being set up, and you'll see them participating in tournaments not just in India but at world level as well. And the focus and the shift of the world has been to move towards esports. If you look at it, there are esports world cups that are coming in. There's been a lot of promotion of esports even on the in the Gulf, the Middle East side. Europe and US have already taken a lead in esports. So I think China is playing an active role. So there is going to be a lot of esports promotion coming our way in the coming future.
Right. Ananay, thank you so much for joining me.
No problem. Thank you so much, Govind.
Why telecom prices are rising? Reliance Jio and Airtel have discontinued some of their entry-level data plans for mobile phones. They've also hiked the cost of some of their prepaid plans, some more than the others, the details of which I'm sure you can find. The larger story is that there is a move up the value chain, so to speak. And the reason telecom companies are hiking rates is thus more fundamental. It's to do with two things. One is consumer aspirations, which is the way you and I are consuming data, including perhaps the way you're listening to this podcast, and their own balance sheets, which is the company's balance sheets, which are changing and improving. Now, consumers across the country are consuming more data and maybe at faster speeds, and telecom companies' balance sheets, as I refer to, are becoming stronger as they now near the end of their major capital expenditure investments in telecom infrastructure. Thanks to which operating profits of telecom majors will grow by about 12 to 14%. A report from Crisil Ratings, which looked at 3 companies with a 93% subscriber market share, has said. Thanks to all of this, again, average revenue per user per month is expected to go to about 220 rupees from about 205 rupees last year. I reached out to Anand Kulkarni, director at Crisil Ratings and the author of a recent report on the subject, and I began by asking him to tell us how and why consumption levels were rising and what that meant in terms of overall telecom spread and connectivity.
So, Govind, let me start with the ARPU landscape. ARPU is the average revenue per user. And let me highlight what is happening there. This typically would have two factors, the ARPU growth. One would be typical tariff hikes taken by these telcos. And second would be the intrinsic demand drivers for this ARPU. Firstly, talking about the tariff hikes, over the past few years, we've seen the telcos taking a couple of tariff hikes, which has supported their ARPU growth over a period. Like what happened last year as well. There was a growth last year. Now, last year's tariff hike is already largely reflected in their ARPU performance of fiscal 25. So the ARPU was around 205 rupees for last fiscal. So on that base, despite we not building any incremental tariff hikes, we expect the ARPU to reach around 220 to 225 rupees this fiscal. Now, to give a context, in fiscal 24, when there was no impact of any such tariff hikes, the ARPU growth was around 10 rupees. Going forward, we expect the growth to be much higher than the past such trends.
And what's the period for this? When you say 200 or 220, what's the period?
So from 1 year, let's say from year after year, in 24, the growth was 10 rupees as compared to 23. So without any tariff hike, the growth was 10 rupees. Now we expect that to be 15 to 20 rupees. That is the delta that I'm talking about. This would be on account of gradual strengthening of the intrinsic demand drivers of the sector. So there are around 3 such drivers that I would like to highlight. And the primary driver all of us know is the surging data usage. Now, for example, average monthly data consumption per user is expected to move from around 27 GB in fiscal 25 to around 31-32 GB in this fiscal. Now, if you give a context to this, over the last 6 years, the data consumption has grown at a CAGR of more than 25%. So that is a very, very strong growth in data surge that we're talking about. One of the key factors for this data consumption growth is also wider availability of 5G networks now. So we expect the 5G penetration to increase which was around 35% as of March 25, is expected to reach around 45 to 47% by March 26. So effectively, we're talking about half of India's active users could be on 5G by next fiscal end. And now what 5G does is that it accelerates your data consumption. So with 5G networks, consumers tend to spend more time on applications. They tend to look at more video streaming platforms, gaming, Gen AI, social media. So all this leads to higher data consumption. So this was one key large driver of the growing ARPU. Now, the second driver would be the premiumization, and that happens through bundling of plans. Now, if you see, the telcos are now offering more plans which are bundling OTT subscriptions along with the basic plans. And there are some other value added services also that can come in. Now, this pushes users to upgrade their existing plans. There has been some rebalancing of plan that has also happened, which results in phasing out of low data limit plans. So earlier, let's say there were many 1 GB per day plans available. Largely, you will see very, very less number of such plans. That happens because people would automatically get pushed to overall ARPU because of such changes or rebalancing. And third driver here would be the rural internet adoption. We spoke about it last time when I was on this podcast. So internet penetration in rural as well as semi-urban is also expected to rise gradually. It has been rising in the past as well. This will translate into users graduating from voice-only plans to at least entry-level data packs, which are typically around 100 rupees costlier for a 28-day validity that we generally talk about. So these three drivers are shifting the industry's ARPU's intrinsic drivers, and that is how the growth is happening for the sector growing.
Interesting. And the companies today are spending less, from what you've said in your recent report as well, that the capital expenditure, that is companies spending on setting up infrastructure networks or telecom towers and making them capable of handling more speeds, all of that is now slowed down.
Largely, if you look at the capital intensity or capex that we call, it is a function of two things. Obviously, your numerator would be actual capex money that is going out, and denominator is the revenue that they are generating. Now, what we are saying is the capex intensity, which was around 31% for last two fiscals, is expected to moderate to around 24 to 26% this fiscal. Obviously, revenue growth is a contributor to my denominator growing, but major contribution will come from lower capex that they are incurring. The first key reason, and it is the context that is important. First key reason is the 5G network rollout that was completed by the leading telcos in the past. That was a significant part of their past capex. Now what we are seeing is 5G coverage is largely done. The leading telcos have reached to a level where the incremental expansion would be less about increasing coverage, but more about optimization or densification of the existing network that they have created. Hence, overall money required, because the build out is largely done on 5G, that would be lower for the capex. Second key reason is also on the spectrum. So if you look at spectrum is another important money that they have to spend on. What we've seen is a significant amount of spectrum purchases were completed in fiscal 23. Last year also we've not seen, this year also we've not seen too much of incremental purchases. So largely spectrum demand is met. What we are expecting is next renewal of the spectrum, the significant renewal will come only in 2030. So till that time, outlay towards spectrum also will be lower. So what we are seeing is, as I was expecting, improving quality and capacity will be more important for these players rather than spending more on 5G coverage. So because of all this, we are seeing capital intensity coming down for the sector. This will also help in better cash flow generation for these players.
Right. So, there are some players who are doing fine and there are some who are not. In the context of all of this, do you see the sort of median health levels improving and, some of the weaker players being able to hold out?
So, right, overall, what we are seeing is if you look at consolidated numbers, overall health today seems stronger than the past. So, when we had looked at in the past, the competition was intense, which impacted your ARPUs, your profits. But today, we are seeing profits are growing at a healthy rate. We are expecting 12 to 14% growth in consolidated EBITDA for the sector. And more importantly, as I was expecting, this was a demand-led growth, and it is not only driven by tariff hike. Second, more important from health perspective is the balance sheet. Now, there will obviously be difference between top players versus some others. But overall, also what we are saying is the leverage for the sector is coming down. And what we are seeing net leverage, that is your debt to EBITDA, net debt to EBITDA, is expected to come down to 2.7 times, which was 3.4 times last fiscal and even higher in the past. So overall also it is coming down. Obviously, the leading players will be better placed as compared to some others to take the benefit of all this.
Right. So it appears to me that as people consume more, their appetite only increases. So it doesn't look like all of us as consumers are moderating or likely to moderate our demand for mobile data or any data for that matter.
No, absolutely, you're right. So, as I was explaining earlier, there are 2-3 factors. One, obviously, the network is giving you good quality or good data speed. Second, look at the 5G handsets, those are available. Few years back, those are very, very costly. Today, you are getting it around 10,000 rupees very easily. All these supply factors are there. On the demand side, every day you are getting more and more apps, data streaming services, social media applications, which are also video streaming, which consumes much more data. So, the entire ecosystem is being built in a manner where the data consumption is expected to grow only going forward.
Got it. And pleasure speaking with you as always. Thank you so much for joining me.
Thank you, Govind.
That was the core report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.